Gold hit once, twice, three times, four times. On the fifth time, we broke out. So maybe that's what we're likely to see here on silver. Fourth hit, and then maybe a breakout.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Dr. Justin Burkholder joins us today. Dr. B, as he is affectionately known as, is an emergency room doctor who now monitors the heartbeat of the markets as a pro trader with verified investing. And we're delighted to have Dr. B as a first time guest. It's time to saddle up and silver up for Dr. Justin Burkholder. Dr. B, welcome to SBTV. How are you doing?
I'm doing well, Patrick. Yeah, thanks for having me.
Glad to have you on as a first time guest. So we'll get to know you a bit. If you don't mind, could you share with us a little bit about your background?
Sure. So I'm an emergency medicine physician by training. I'm from Philadelphia. I went to college and medical school up there. I was a big high school and collegiate athlete. And so after medical school, I went down to Miami Beach for residency at Mount Sinai Medical Center, trained in emergency medicine there. And then once I came out and graduated, I came out and joined a private practice in Cape Coral, actually near Fort Myers, and practiced there for about 4 or 5 years. And about a year into my practice as an attending, I started to have hip pain, and I went to my orthopedist. I was diagnosed with a hip condition, and I actually had two hip surgeries. So I was crutching around. This is around COVID. So I had a hip surgery. I couldn't walk for about 2 months. I got back into the ER, and I remember I was on crutches during COVID, trying to intubate people during that pandemic, and it was very tough for me because, I was recovering from surgery, practicing emergency medicine and going through pandemic all at the same time. And about 6 months later, then I required surgery on the opposite hip. And basically, what had happened is, as you know, through my athletics in high school and college, I was a wrestler, I was a triathlete, cross country runner, tennis player, mountain biking, all sorts of things. I looked back and I realized that all of that activity actually probably, damaged my hips. And I also had a small congenital anomaly that I wasn't aware of my entire life. Hip dysplasia, labral tears, things like this, and that kind of degenerated, the hip joint quicker than most people. And so my orthopedist at the time said, "Look, you really should take a desk job because you're going to need a hip replacement much sooner in life." And so I was a bit stubborn. I didn't listen to him for several years. I kept going. I kept going. I told my wife, I really want to become a partner in my group. And I did. I did partner in my group, but every shift I was in pain. I was having more and more difficulty, getting to patients in the ER, getting back and forth from the ER to the ICU. I would run code blues in the ICU and then back to the ER. So it was a lot of walking, a lot of kind of pivoting on our feet, dealing with, heart attack, stroke patients, sepsis, right, bad infections, drug overdoses, drowning victims. I mean, trauma. So as an ER doc, more so than most specialties in medicine, you really do have to be on your feet. And so I was diagnosed with a condition that really kind of took me out of practice. It was difficult for me, to leave practice. But I made the decision to do that and take a desk job, and my hip pain has been much better. Um, and really, kind of how I transitioned was I was in my chair for 2 months. Again, I couldn't walk for 2 months on after both surgeries. So 2 months on my right side and 2 months on my left. So a total of four plus months I was in my chair, and this was right around 2020, 2021 when the markets were just, booming. And that's when I said, wow, I really need to learn this. I was actually a finance major in college. '08, '09 happened, and I saw the absolute devastation in the financial markets. I always had an interest in science and medicine. My father is a physician. My mother's a nurse. And so I went to medical school, and then I realized, all right, well, I can't practice this anymore. Maybe I'll go back to, one of my other interests, which was finance. And that's kind of what I did. I started to learn technical analysis. I started to learn about, fundamental analysis as well, and how to value companies, and really got very interested in technical analysis and how the markets move, up and down, sideways every day. And it really was just a very difficult time for me as I was leaving practice, but also a very interesting time as I was learning really kind of a new career, a new specialty, if you will. And yeah, so that's my story. And so when I left practice, we moved from Fort Myers area, my wife and I and my son, and we came up here to Tampa, and I was continuing to study the markets, and I contacted Gareth and said, "Hey, can I come in and spend a month with you and your team?" And that's what I did. I came in for a month, trained with them very intensely, and really just kind of dived in, dove in, head first, and stayed on board, and now I'm part of the company and the trading floor and a variety of other things. So yeah, that's my story.
So now we know how you went from monitoring people to monitoring the markets. Interesting because at that time, we saw the Fed really step in and be a backstop for so many companies, and we heard that term back then, zombie companies. Zombie companies, and maybe companies that should have went down, the Fed was keeping alive. When you first heard that term, what were your thoughts about the Fed intervention and keeping companies afloat that maybe should have went down?
Yeah, the Federal Reserve, they've been stimulating the economy for years now, right? We had the quantitative easing push during or following the Great Recession, and I think if you look at the markets, the S&P, for example, we'll look at the weekly chart, and you can see here, this is the bottom of the Great Recession, and you can see that the general slope of the markets was something like this, right? This was the kind of the general slope of the markets. But if you look at the slope of the markets after quantitative easing started to hit, look at the slope. It's almost, you know, straight up. And sure, there was some pullback in quantitative easing for a while, and then of course quantitative tightening started somewhere in this area. But what actually happened was during the banking crisis last year, they had that emergency loan program, and that was essentially like pseudo quantitative easing all over again. And I think that's probably why we've had such a big run here in the markets. But going back to your question, what do I think of the Fed helping some of these companies or helping the market when really there should be a correction? I think it's unhealthy. I think it's unhealthy. If you look at the debt, the U.S. debt, if you look at how that just continues to go up without a pullback and without kind of a stabilization and a healthy curve slope up, I think I think it's I think it could potentially lead to a disaster in the long run, where we're kicking the can down the road. Politicians, tend to create policies that are good for the economy, good for the equity markets, and just tend to push asset values higher and higher. But at some point, yes, the American economy is some of the biggest, the best economies in the world, one of the strongest economies in the world, if not the strongest. But at some point, when there's so much money printed, like as we saw after COVID. Um, at some point, something has to break, right? Something has to change. And if you look at this chart here, you can see that we are very, very extended from the Great Recession. Now, of course, this is all economic productivity and increased GDP and all of these different things, and that's great. But at some point, there needs to be kind of a leveling out of the slope. If you look here, this slope was somewhere like this, right? We would all agree this is the general slope. Well, we really kind of need to get back to that slope. And really, what we're seeing is just a straight up move in the markets. And that worries me, to be honest.
If you're enjoying this interview with Dr. B and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? To find out more, go to www.silverbullion.com.sg, click on the signups tab, and choose from these 6 types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. Yeah, I think that it worries you. It worries a lot of us as well. Thank you for showing that chart. It charts typically. I'm looking at a weekly or monthly chart to get a pretty broad look at the markets over some period of time. However, you have a technique with 1 minute charts. Could you go over that with us?
Sure. So, you know, where I kind of focused on 1 minute charts was during the banking crisis last year. I was looking at some of the regional banks that were down 50, 60, 70%. Um, and I was zooming in. I would kind of take a broad picture look. I would zoom in. Let me see if I can find a chart right here on let me just change this here. So FRC is a bank that I remember trading, and looking back, it was a bit risky, right? But I would go in pretty small. You can see FRC here had a big drop here in March of 2023. And what I would do is I would zoom out, get a bird's eye view on the weekly and the daily charts, and then I would go into the 1 minute charts. And here's the 10 minute. And let's go in further to the 1 minute. And what I would do is I would find patterns that would repeat. For example, falling wedge patterns. Okay. Now this may have been the pattern I traded, but you can see this pattern right here. Okay, is somewhat of a falling wedge pattern. What I would notice is these stocks would be beaten down 20, 30, again, 50%, and they would all of a sudden have these big rebounds. And you can notice here, this is just a 25% gain here to this white line. This white line is VWAP, which I use throughout the day. But I really started to find alpha using technical analysis with the 1 minute charts, and I started to do more research and realize that there are top professional traders using the 1 minute charts. And while many people may say, "Well, that's too fast, that's too much," it's unbelievable how it works, and it works every single day. You can join our trading floor here at Verified Investing and see the charts that I draw, you know, uh, on the floor and make the calls based on the 1 minute chart. So I actually have a course. It's called the 1 Minute Scalpel. Um, and it kind of looks like a scalpel. That's why we call it that. Plus, I used to, use quite a bit of scalpels in the ER. So, um, anyway, yeah, that's my 1 minute strategy. And there's much more to it, of course, but that's the general premise.
When it comes to trading, charting, forecasting, we hear the word fundamentals. Can you define that for us?
In general, revenue, right? How is the company's revenues? How are their earnings? What are their expenses? How much debt do they have? What is their guidance, right? What are their sales likely to do over the next couple years? What's the sentiment among the market participants? What's the sentiment among the consumers? So a lot of it's numbers, it's balance sheets, income statements, things like that. That's really fundamental analysis. Yeah.
The reason why I asked that is because there is a good segment of investors out there who believe, there's no true price discovery anymore. There's no free free markets anymore because of that Fed intervention that we spoke about, government intervention. Um, but even still, do you see through your charting that there still is a way to find true market price discovery?
Sure. You know, when people ask me, and there's been a lot of debate about this, I think over the past 10, 20, 30 years, where fundamental analysis was really kind of the gold standard, if you will, right? Warren Buffett and Benjamin Graham, the intelligent investor, they talk about value investing and looking at companies with solid revenue, solid earnings. All that is well and good and very true and still present today, right? But I think that what became very obvious for many, even though many don't like to admit it, is that technical analysis is just as good, if not better, than fundamental analysis. And really, what I think is the ultimate package is merging fundamental analysis and technical analysis, right? Finding a company that is undervalued, that is at a good technical level, and you can combine those two and really generate significant alpha. So for example, this is the S&P 500, the SPY ETF, and you can see here that this is the dot-com boom right here, dot-com boom, the peak. This is the dot-com bust, and then this is the peak right before the Great Recession, and this is the lows of the Great Recession. Well, what do you notice about that? What I notice is that these highs, okay, essentially were at the same exact level. If I were to draw a line here, you would see that this is a very large double top pattern, okay, double top, and the same thing on the opposite side. Whereas you have these pivot lows here. Now, this was a black swan event, so you did have a pierce of that price action, right? So probably about 10% deviation there with these lows. But in general, if somebody asked me, okay, let's say we're here in time. Let's put the replay on. Let's say that we are coming off the lows of the dot-com bust and we're saying, okay, where are the markets likely to go to and get rejected? Well, I would say draw a trend line here. This is where they're likely to get rejected. And if you look at that on replay, right? And again, this is going to take a little while, but if you look at that on replay, you'll see that the price comes right up here, hits this area, and comes back down. And this is really what we do. This works on a weekly chart, a monthly chart, an hourly chart, a 10-minute chart, a 1-minute chart. And this is really how we think about technical analysis. Where are the pivot highs? Where are the pivot lows? Where are the Fibonacci levels? Where are the trend lines? Where are the moving averages? And we put all of this together and we come up with a thesis, if you will. We come up with a thesis of where we would like to enter long, where we should enter short. And if that thesis is invalidated, then we change our plan, right? Just like me in the ER, um, if I had a diagnosis on a patient, if I, said, all right, I have these top three diagnoses of a patient, and I get a lab value back or a CAT scan back that's different from what I was initially thinking, well, then my thesis is invalidated. Now I need to change my thoughts. And it's the same thing in trading or investing. And so anyway, I'll exit out of this replay mode. But basically, that's what we do. We look for big pivots, big changes in the charts that allow us to use technical analysis. And you can see here, for example, on the S&P, where what's really interesting is if you take a trend line here from the Great Recession highs and right here to the 2021 highs, all right, what's really interesting is you do see that price get rejected right there at that line. So people often ask, hey, the fundamentals said this, but the market actually did that, right? And oftentimes the market moves based on technical levels. Let me just show you another example. So you can see here, right, this pullback off this line. Let me show you another example. If you were to ask me here, let's again, this is pretty amazing, and I hope that your viewers love this, right? So let's say that we have the COVID lows right here. These are the COVID lows. These are the 2021 highs. And we would be thinking that this was a possible high because you can see here, higher highs, higher lows, higher highs, higher lows, so on and so forth. But you notice that this is a higher high, but all of a sudden a lower low. So we're thinking that, okay, now the trend is changing. The trend is changing. And if you were to say to me, where is the price likely to retrace to? I would say most likely to the 50% Fibonacci level. So let's take a Fibonacci tool from these lows to these highs, and we're going to do a replay here. And it's going to amaze you. I imagine it should amaze you where this price uh, bounces. Again, here's the 50% right here, this zero point 0.5 Fibonacci level. So as we know now, that was the lows of 2022. And it was very simply done by looking at the 50% Fibonacci. Now, there were a couple more things to that, right? If you were to pull up an RSI, you'd see bullish divergence. You can see the weekly 200 moving average here. It hit the 200 moving average, right? This is the yellow line. You can see here that price hits or kisses the weekly moving average here. It also hits the weekly moving average here. So every time, right, for essentially over a decade, the price comes to the 200 weekly moving average, hits it, and then bounces. Now, just like the Great Recession, COVID was a black swan event, and we pierced this level. There was a deviation, right? A lot of fear in the market. That's why we got such a pierce and a pullback. But really, just amazing when people say, technical analysis, it doesn't work. I'm sorry to say, it really does. And there's the proof, you know?
Okay, some pretty good stuff there. The Magnificent Seven stocks: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta platforms. They make up almost 30% of the S&P 500's performance, and I think about 40% of the Nasdaq 100's performance. Would you say this is healthy to have such a small amount of companies taking up a pretty big slice of the pie?
The long and short, very simple answer is no, right? When you look back at the dot-com boom, that was a very common theme that a very small amount of companies had a large share, percentage of the market. I think Oracle was a great example of that. And really what that leads to is it sends it essentially is an unhealthy market, right? A healthy market, you want to see the majority of companies having a nice steady upward move. When you have just a handful, and yes, we have had more companies um, have meteoric rises, but in general, when you have such a concentration with the Mag 7 uh, as a portion of the gains in the markets, that creates a very risky situation in the sense that all it takes is for those seven stocks to pull back. That will put pressure on the S&P, the Nasdaq, and when that happens, there will be fear in the market, which will drive down the rest of the stocks. Whereas if you have a very wide breadth market with tons of stocks moving up. If seven stocks pull back, well, that's unlikely to really affect the overall market direction. But if you have, 100, 200 larger stocks at that point pull back, well, then likely you'll start to see a pullback. So it does give me a little bit of reminiscence of the dot-com boom. Clearly, the gains, for example, the earnings and profit margins in NVIDIA were impressive, very impressive. But if you look at that chart, again, it's just overdone. It's overdone. Anytime you see a chart like this that's straight up in the air, most of the time that's gonna come down. So, and as we did see from the highs here, a 20+% move to the downside. But I expect Nvidia, honestly, in the correction, probably to come back here to about $500, which would be about a 40%, 45% pullback in Nvidia.
Well, it's quite a bit. I was thinking, and I hear people also, they mention, they do see a correction or a pullback, but they're looking at maybe 15, 20%. Do you see the same or something different?
Yeah, so in the S&P, for example, I actually see that exactly. If you go back to my March, I think it was early March interview with Michelle McCory, I did talk about the S&P coming back, pulling back about 10 to 15%. And this is why, again, just using technical analysis, right? We saw this big trend line here from the Great Recession highs, right? Pre-Great Recession highs. And then if you take a trend line from the COVID lows up to this area, you can see that the market clearly is overdone. It's up about, let's see, almost 30% from the October, November 2023 lows. And you can start to see this wedge forming, right? This wedge pattern forming. And as we know, the price, tends to stay in a pattern until it doesn't. And usually rising wedges tend to break down. But before the larger breakdown, I do expect a move down into this trend line, okay? I'm expecting about 450 on the S&P, 450, which would be from today's highs, somewhere around a 14, 15% pullback.
Yeah, with the markets being overcooked, as you say, how do you see gold and silver? Do you see some of that money moving into precious metals?
Yeah, I think there's significant upside to silver compared to gold. If you look at the gold chart, you can see gold essentially touched all-time highs, has pulled back. It broke out of this range here that it's been in, for several years. A little bit of an inverse head and shoulders pattern, nice breakout to the upside, and we are very close to all-time highs on gold. But if you look at silver, silver again is really a bit subdued compared to gold. Silver is trading at about $28 per ounce. You can see the previous all-time highs were around $50 back in 2011. And I do see a potential move higher on silver, likely a similar breakout on silver as we saw on gold. If you notice, this inverse head and shoulders pattern played out nicely on gold, and honestly, there's a very similar pattern here on silver right here. Left shoulder, head, right shoulder. So we may have already broken out of that pattern and are really just kind of continuing higher. But if you look at these pivot highs right here, this is likely the next resistance point. And again, going back to technical analysis, understanding how the markets work, how the charts work, we came up here, we pulled back, we came back here, hit that area, pulled back, and then we chopped sideways or a little lower for a little while, and again came right up here and pulled back. So this line, about $29, about $30 on silver, is really the line in the sand for silver. Once silver can get up above this line and break out, that's when I see the upside on silver happening. And so what I'm likely to do is wait for a breakout on silver, wait for a retrace here. This is the safest area on a breakout, and buy silver right in this area. And I think you will have significant upside. And basically, you know, when would that be? I think that would be when fear comes into the market. when the S&P is pulling back and doing something like, doing something like this, or maybe even something like this, that's when I think the commodities and the precious metals will run.
Okay. Yeah, appreciate that because silver it knocked on 30's door, $30 door once already. It was 29. I forget what it was, but it was above 29. Pulled back. How many more times do you think it may have to knock on that door before it can finally get through that 30?
Yeah, so let's take a look at let's take a look so far. So we've already hit it. This is the third hit, right? Third hit. Typically on the fourth or fifth hit, what Gareth has taught me is on the fourth or the fifth hit, there's a high likelihood of the price breaking out. And the idea is that if you are, you know, if you are banging up against a door and you're trying to break that door down, well, like unlikely you're going to break it down on the first hit. But after the fourth, fifth, maybe sixth hit, you're likely to break through that door. In this case, the blue line being the door. Let's go to gold, and we can maybe take a little historical evidence from gold. Gold hit once, twice, three times, four times. On the fifth time, we broke out. So maybe that's what we're likely to see here on silver. Fourth hit, and then maybe a breakout. So it's going to be interesting to see.
All right. So maybe with that breakout, we may see silver close that silver to gold ratio a bit.
Probably. Mm-hmm.
Okay. All right. Great things to look forward to. Dr. Justin Burkholder, before we head out, can you tell us about verified investing and the services you provide?
Sure. So Verified Investing is a great company where we have a variety of resources and things such as the Apex Live Day Trading Room. We have hundreds of people all over the world dialing in, looking at our charts, going back and forth with the different levels. Right, Gareth and I go back and forth and talk about the levels along with Benjamin Poole, and we call out trades. We call out actionable trades every single day, just about every single day. We average about two trades a day. We have an 85+% success rate in 2024. And Gareth has been doing this since 2007 with a very high success rate. There's also a swing trading service, right? If many of don't have the time to day trade. So there's day trading, there's swing trading. There's also a variety of educational tools such as courses, my 1 Minute Scalpel, Garrett's Winning Trader series. So there's really a very interesting collective educational resource here. We've just redone our website where we have a lot of uh, information for the investor and the trader, and we've really made it in a way where you can go to one website every day, and that's like your go-to website. There's so many different websites out there in the financial world, and we've combined all of the most important metrics in the financial world onto one website, and that's really an amazing thing. So we educate people, we trade, and it's a very very great environment. So come join us, verifiedinvesting.com, and hope to see you there. Yeah.
Yeah, I appreciate that. I know a lot of people, we're just looking for information, we're looking for education, and I think that that 1 minute scalpel, I think that will appeal to a lot of us because we really want to get in on the quick, get in on the quick and fast and see what we can do with that. So I appreciate that. Dr. B, I'd like to thank you for your time and I hope we can do this again soon.
Thank you, Patrick. Yeah, just contact me anytime. Happy to go through the charts, and thanks again.
That was Dr. Justin Burkholder sharing his views on charting, precious metals, and the economy. To see more of Dr. B's views and work, please go to www.verifiedinvesting.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio only versions of this interview can be found on iTunes and Spotify.